Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending May 13th, 2016. What I have on the screen here, you should be familiar with. It is the Emini SP 500 futures, and I've got a weekly chart up here, and I just wanted to take a step back again just to remind everybody why I am going into the latter half of May into June probably with a more bearish bias than a bullish bias. Perhaps let's call it neutral to slightly bearish. I think the markets are a little bit tired. Now, things may change, as they always do in the markets, but at least the way I'm looking at price action now, that's the way it's kind of showing itself to me. Like I said, we've got the chart up here, and you can see going back, I've done this before, but I'm just kind of remind everybody, again, this is a weekly chart going all the way back to the beginning of 2014. And you can see we've been in a very wide range, working our way up, all the way down, up, and now we're somewhere right in this area right here. This range here, although it's a wider range, can drive a lot of longer term position and hold type traders crazy. This is why in 2015 and going into 2016, a lot of fund managers have had a lot of difficulty in navigating these markets. Typically, a lot of fund managers have to be invested in the market by charter, and it's very hard to pick a direction and stick with a grouping of stocks when you reverse and you do these big reversals down and then big reversal up, big reversal down, big reversal up. Net, they're not doing very well. Now, for folks like you and I, where we can jump in and out of the markets and pick a direction or pick a bias and stick with this for a few weeks or perhaps a month or two, it works out to our advantage. But for those of you out there that would be what I would classify as rat brain traders, typically what you're doing is you're doing a lot of selling down in this area here, and you realize the markets move against you, and you're doing a lot of buying up in this area here, just at the time when the markets start moving against you again. So you just need to change your out of focus or your phase shift, your timing of your buy and your sell. And you can get that by just really understanding how to look at these charts, how to look at price action, and combine them with a couple of key technical indicators. And the best way to learn, obviously you can pick up books and read them, but I think join an active group of traders, and then just through osmosis and through experience, you'll be able to pick a lot of this up, because it's really not that self-evident in reading books. That's why our user group continues to grow and grow. So enough of that, but let me just kind of zoom in here. This again is the S&P 500 futures, and you can see here on this weekly chart right now we're near all-time highs, right? All-time highs for the S&P is 2134, and we're not that far away from all-time highs. I got a couple of Fibonacci's on here, but I don't want to talk about them right now. I just want to focus on the all-time highs. If I look at this and I just kind of do a very quick review of where we are in the all-time highs, we're only down a little over 3%, 3.5% or so from all-time highs. Okay, that's not bad, right? I mean, but the markets are getting very weak up here. They seem tired to me. You can see we made the all-time high back here in May of 2015, and then we've just slowly tried to take out these highs, and we're just making lower highs as we go forward in time, okay? And we're holding up down at the bottom, hence we've got this wide range like this, yet we're not able to take out key prior pivot highs. All right, that is one thing that I'm watching very closely here. The other thing, when you look at these charts like this, and let's say we put volume on here, and I've shown you this before, and let's take it down to a daily chart here. And we look at volume. You can see on my volume chart, well, that's a little bit too tight. You can see on my volume chart, I've got two lines down here. One's a 5 EMA and one is a 20-day EMA average of volume. So just like you can on a chart, I like to show EMAs on volume. And you can see here where, we've had these big down moves like this, right? You can see in the down moves here, the 5 EMA goes over the 20 EMA, and you can see all that volume. So that's that's a lot of selling right there. But then, and again, I've shown this before, but if you look at this movement right here, and then you compare it with the volume down here, is very weak, very lame. The 5 EMA went below the 20, so it shows that even though we had a bounce here, it was supported by low volume. And then the minute we come back down again in that move right there, volume comes back up again, okay? And then we've started this long trek up. And if you've noticed, volume has just, on average, the moving averages have been going in the wrong direction, okay? Not good. And we've got a similar tail over here when we had this big move up here. You can see the 5 EMA is generally below the 20 EMA on these big moves up. And, the way I would look at this and interpret this is there's a lot of distribution going on, and generally you got most of the big fund holders and shareholders selling to more rat brain folks that, they're doing their buying up in this area here, and then, they hold it for a week or two, and then it starts going down, and they wonder what the hell happened. But I'm seeing volume is not supporting what I would like to see to make us run higher. Now, that doesn't mean that we can't come up and take out these highs. Of course we can. But it's just not supported the way I would like to see it supported. Now, the one thing is on this daily chart, let me just zoom in a little bit and widen it out for you guys with bad eyes. You can see here is the 50 EMA. Here's the 200 EMA. And we went below the 50 EMA here and here, but we always managed to close above it, okay? So right now, the 50 EMA is holding up for us. That is a key psychological barrier for a lot of folks, and a lot of black boxes that have some of this stuff programmed in too, that say I won't buy any stock that's below the 50 EMA, or any stock falling below the 50 EMA, I may look at short. And you can see we got the cross in the 50 and the 200 up above. And I've said this multiple times, when you have a cross like this, price action by time you get that cross is already well extended from when that cross happens, just because of the lag. And I said generally when you have that, price will come back down to around that area again and then shoot back up. And again, it takes time, but I can't tell you how many times I've seen the 50-200 cross, price action comes down and meets that and then runs back up again, right? So, likewise, we had the 50-200 cross here, and then price action, by time it crossed, we were way down here, and then the cross came back in and it took it out right here again. Finally, we get the cross right here, and I could probably extend that out and make an argument or a case for price action coming down and then moving back up here like that too. Also, for those of you that follow Elliott wave analysis, you can see we're at a 4-leg possible, or 3-leg, 4-leg, and then a possible 5-leg up here, giving it up, and then we roll over. Needless to say, we're also coming into mid-May, end of May, into June, and you've heard the term sell in May and go away. I'm sure every one of you have heard that before. And generally, that is correct. I've read stats that if you only bought in May and sold in October, going back till after back after the Depression in 1929, your average return would be not very much, almost flatline. And then if you did the same thing and you bought in October, September, October timeframe, and then you sold in April, meaning you held it for the other time of the year, you would have made a tremendous amount of money. So we are entering a traditionally weak period of time for the markets, and we are near all-time highs here in the Emini SP 500 future. Now, if I come in, and let's go over and look at one of the markets that's doing the poorest right now. This is the Russell. If we look at the Russell, and again, let me take it out. You can see here, this blue line represents the all-time highs in the Russell. And again, summer of, this was June of 2015. And you can see where we're sitting right now. We're sitting right around this area right here. And if I were to just kind of take that and measure that, right? And just do the same kind of analysis. You can see here with the rut, we are down almost 15%. Now that's hard to believe, right? We're down almost 15% in the rut, only down a little over 3.5% in the S&P. Small cap, mid cap, there is no money coming in here right now. Mostly small cap. You can see we were in official bear territory February the 11th. We were down, guys. A lot of people didn't realize this. The small cap was down 27%. That's a typical bear market in small cap. And we moved out of bear market territory right in this area right here, which you would say was around the end of February going into March. We moved out of bear market territory, but just barely, okay? So just keep that in mind. We need to see small cap participate, and we are not seeing it participate. The other thing is, just like the S&P 500, we're making lower highs, all right? And, you know, if I wanted to connect this line, probably not very strong, but you know, you could, or my line isn't very straight or very accurate. It may come down just a little bit here. We poked up a little bit right here, but we're still nonetheless following this overall trend here to the downside. Okay, again, not a very good sign. And then if we shift over to Nasdaq hadn't been doing very well lately either. If you look at, well, let me just show you one thing on the Russell here, or before I go back over to the Nasdaq. If we come back to the Russell here on a daily chart, let me put all of my indicators in here. You can see right here, we're still in the red for the Russell. There's the opening price, 1132. We're sitting here. The Russell closed on right at 1100, almost a psychological number for the rut. 1132 is the open price for 2016. We're in the red. Just barely did we stick up above here, but we've been in the red almost the entire year for the Russell. If we look at the E-minis, and I put all of my indicators in here on the E-minis, and we'll just zoom in here because I got a lot of indication or a lot of things that I'm tracking here. You can see we came down on Friday, and we actually just about touched the 2016 open price here of 2037.75, and we bounced just up above it, and we're holding just above the 50 EMA. So we're just barely in the green on the E-mini S&P 500 futures, and we're in the red on the Russell. If we look at the Dow, right, and we take a look at the Dow on a daily chart, you can see we're in the green, but barely on the Dow as well. You can see, however, on the Dow, we did close below the 50 EMA. So that's showing price weakness as well. Like all others, we're making lower highs. That's not a good sign, guys. Now let's look at the Nasdaq. If we take a look at the Nasdaq, it was the best performer on Friday of a bunch of bad performers all around. Look at where the opening price is, 45.92.50. We're in the red for the year for Nasdaq. In fact, we've been in the red for Nasdaq futures, the Nasdaq 100 futures, all year long. In fact, you can see the 2016 low actually took out the 2015 low down in this area here. The 2015 high is higher than the 2016 high. So we're not doing good in Nasdaq either. All right. And the other thing that slipped by a lot of analysts I saw, but it'll probably come back on Monday depending on where we go. But look at what happened this past week. The 50 crossed back below the 200 EMA again. You see that cross? Now it's unusual to see the 50 cross above the 200 EMA and then literally less than a month later cross back below the 50 again. Folks, that shows a lot of consolidation. Now on this daily chart, it doesn't look like it because we're way up here, we're way down here, and you could say, hell, Brent, that's not consolidation, you're all over the place. But if you stretch it out, right, and let's come back to a weekly chart, much like I did with the S&P 500. And let me just take everything off the screen so you guys can see it a lot better. It's just like the S&P 500, guys. We've got a very wide range here that we've been trading in, and I can draw it just like that. It's fairly simple. and it goes back to, I could go all the way back, but going at least through the summer months of 2014, you know, we ventured to the highs, we've come to the low, and we've come, you know, like that. So we've got that going on like that, and that's where we are right now. So we will break out of either that or that. We will break out. I believe the odds favor a breakout to the downside before we go much higher again. For all I know, we may have made highs for the next few years. I do believe that since March 6, 2009, we've been in a bull market. Yes, we've had for the S&P 500 and for the Dow. We have not been in a bull market that long for the Russell. As I said, we fell 27%. But the E-minis, the S&P 500, this is the second longest bull run without falling more than 20%. I do believe we're going to get that fall. And if we swing back to the E-minis, and I've showed this before on a weekly chart, you can see here on this weekly chart, going back to the nice run here. Let me clean it up for you guys. You can see on this nice run here that a 20% pullback is going to take us right down to about that 1700 level. Now this is 1702, but it's roughly right around the 1700 level if I even the line up roughly. So it gives us that 20% pullback, but I very rarely have I seen a bear market. I don't think I've ever seen a bear market that stops at 20. It generally goes down to 25 to 35%. That's kind of a common area. So if we were to extend that down, what's really amazing, you know, let's just take it down to split the difference right in that area there, right? That's 27%. That is a key fib node right here, which I would not be surprised. And if it gets even uglier and it takes us down, you can see right in that area there. And by the way, a lot of bear markets, 34% is not a big deal. So I would say we got two pressure points that I'm looking at. That one right there and that one right there. All right. This one is the key one right here, though. This area here has got a lot of support on. So that would be where I would kind of favor an initial stop. And what would that look like? Well, percentage-wise, if I were to just draw that back in, that would give us right between, I said, the 25 or between 20 and 30. So that puts us at 26%. And if I swing out and put some perspective on this in distance, you can see right away that that area there, if I were to extend it over like that, guess what? It incorporates the highs from the dot-com bubble and the highs from 2007 before we really gave it up. So this is a key level. Now, when do I think we're going to challenge that? I believe in the next 18 months, you know, and no one in their right mind can tell you when, but I believe before we finish 2017, we're going to have this kind of experience. I don't know what's going to be the precipitator that's going to move it down, but the odds clearly favor it. And I will also say that the way the market action has been occurring here for the past year and a half, this is like a standard topping pattern, right? Markets move down, they move up, they fall down, they make another run attempt, they come down, they make another run attempt, they make a run attempt, they may even take it out and do one of these kind of things, and then boom, they start giving it up and it starts getting ugly. And they just keep failing at maintaining escape velocity and going higher. And all these repeated failures here, as we move forward in time, is going to wear down the market, and then we're going to get that run. Okay. Now, there's going to be other tells for us, and for our members, we're going to go through some of those things on breadth of market and a few other things that'll give us a good idea. Like we knew in advance before this big August drop that we had right here, we could see going all the way back here over almost a year, we could see breadth just getting weaker and weaker, and you can't tell the exact day that the markets are going to plunge, but you can certainly start putting your hedges on, and you can start taking some of your longs off and having tighter stops out there, right? I mean, that's a given. Now, if we come down and look at a couple of other key markets, take a look at volatility here. It closed Friday at 1504. You can see, as you guys know, I like to do my zones. because it kind of helps a lot of members when we look at this. Just give you an idea where we're sitting overall. We're in zone 1, but going into zone 2. Zone 1, you do use different option strategies and when you're in zone 2 as you do in zone 3 or zone 4. These zones classify the degree of volatility and option premium versus no option premium and no volatility. And as you move from zone to zone, you will be able to say, look, I'm in zone 4, so I need to be focusing on these types of option strategies versus others. You know, so again, looking at this on a daily chart, you can see how we've just slowly edged our way up, and we're sitting right on that divider line between zone 1 and zone 2. Okay. The other thing that I'm watching very closely is the bond market. Long-term yields have stayed very low, a lot lower than people thought for a lot longer, primarily due to low oil prices, low inflation. But I can tell you guys, as oil starts to creep up, even by a little bit, even if it doesn't go much higher, it's going to start introducing pricing back into the market, and it will start to bring inflation back into the market as well. We're moving up in bond futures, but I just don't see bonds running much higher. I had a target price here that we hit perfectly at 170. If we have a major capitulation in the markets, yeah, bonds will get up here. I don't see a major capitulation yet because there's still a lot of strength underneath the market right now. That doesn't say it can't happen, but the odds favor it not happening. And the odds favor bonds getting soft up here and not going much higher. And if we look at the currency market, because that's another thing we follow very closely, you can see here in the U.S. dollar, as I take a look at this chart here, you can see in the U.S. dollar, we're bouncing off the lows because really the lows were in this box. We've been in this range here, and we poked out of it, but we quickly, I mean very quickly, moved back up into the, you know, the lower range, the lower 20 percentile range of the US dollar. Now, if the dollar starts slowly creeping back up, that will be in contrast to the bond market also moving up, which on the surface appears to be a dichotomy, because generally when bonds start, or when the dollar, US dollar, starts getting stronger, you anticipate more inflation, you anticipate more interest rates down the pike. But yet we've had lower interest rates, or interest rates staying low or going lower, and the dollar moving higher. So these are two biometrically, I don't know if that's the right word, right? Biometrically. They're two diametrically opposed phenomena going on right now. So one of these is going to break the other way. The Feds are between a rock and a hard place on what they're going to do. It's silly season in the U.S. It's 50-50, guys. Try and make a guess. The 30-day Fed Fund futures is saying it's only 50% going out to the month of December that they raise their rates. December. That's post presidential election period. I think volatility is going to stay higher through the summer because just not knowing the outcome of the uncertainty of the presidential election is just going to introduce more volatility in the market. But the dollar and the bonds are going just the opposite. One of them is going to break. I don't know if it's going to be the bonds or the dollar. I do believe over the next 16 months we're going to have higher interest rates, and then once interest rates start moving higher, they're going to move higher very quickly. But we're just kind of hovering down these lows right now, primarily because, not because of the U.S. investor, but because of European and Japanese money is coming into the U.S. markets, primarily into the bond market. If we look at gold, gold has had a great run this year. I mean, if I were to just kind of block this off like this, you can see 2016 highs for the gold hit my target and started moving down perfectly, 1306. My target was right around 13, but it hit it and it started moving down, but there's still strength in gold. We got the divergence that said take some shorts in gold near term, but you can see this red line, the 50 EMA, where the gold has just been riding this thing up. We had the cross in the 50 and the 200, so that does suggest there's going to be some weakness in gold, but you can see this little support zone here right around that psychological barrier of 1200. I would expect a little bit more weakness in gold, but I think this year is going to finish with gold a little bit stronger than where it was. Now, I've been playing silver to the upside. I started accumulating silver back in this area here, and it's just had a nice move up. But like gold, it's moving up also. But I do believe there's going to be a little bit of near-term weakness before it gets stronger again. GDX, the gold miners, this one here has just really outdone itself. You can see here, this has moved a lot further faster than either gold or silver because it also underperformed. I believe in this area right here, this could be a really interesting short-term play on gold miners, maybe selling some calls or picking up some cheap puts here, just looking for a drastic pullback. We got a little bit of a divergence here, so I think longer-term gold miners is going to continue that bullish strength, but just doing some short-term shorts could be an interesting play. The other thing is oil. If we look at oil, this is another key market we've been following here. You can see in the oil market here, this is a daily chart. We had a beautiful signal here for our members. You know that we started getting long right in that area there. And I said over allocate in the energy sector, at least that's what I did. You can see that we just blew through the 50 EMA, we blew through the 200 EMA, and we're looking to get across here. I do believe we're going to get a little bit of a settling in oil somewhere in this area here before we go higher. We got a little bit of a diversion setting up there as well. So I think near term, and you can see that price over volume right there shows that we're right in that resistance zone in this area here. So if we can get above this area, we can run up and challenge this area here. But I just don't think near term that's what's going to happen. In fact, what I've done is I've gone out to August, you know, for our secret trader folks, and I put a trade in using this as a key benchmark in the oil futures market. So that's kind of where we're sitting with oil. And then, of course, in the agricultural market, we're playing soybeans. We're having fun with soybeans. You can see this huge move that we had in soybeans right here off this bottom low. Bam, all the way up. We made 2016 highs. I think soybeans here is probably going to, you know, do one of these kind of things. The chart will look like that, right? It'll be all over the place, but it's going to be limited upside. I don't think it's going to get much above that area there, and we're taking advantage of that in the options market in the soybean futures as well. So these are just some of the trades that we're running. All right, everybody, have a really great weekend. Summer is upon us. And for our members, I'll see you Sunday night. If you're not a member, we're growing our group very rapidly. I highly recommend you come on in and check us out. Otherwise, guys, I will see our members tomorrow night. Have a really great weekend. Ciao, everybody.